Bonus depreciation and Section 179 both accelerate cost recovery, but they behave very differently. Section 179 is an election you can dial up or down asset by asset, but it's limited by taxable business income and can't create or increase a loss. Bonus depreciation has no dollar cap and can create a loss. On the EA exam, they love asking which one is limited and which one is mandatory unless you elect out. Here's the strategy angle. Section 179 is flexible. You can expense all, some, or none of an eligible asset and pick which assets get it. Bonus is the opposite. If property qualifies, you generally must claim bonus in the placed in service year. You can't save bonus for next year. So planning often starts with, do we want the automatic big deduction now, or do we need income to stay higher? Now, what property qualifies for bonus depreciation? Think. Most tangible personal property with a MACRS recovery period of 20 years or less. Add a few special buckets. Qualified improvement property, purchased computer software, water utility property, certain film and live theatrical production costs, and fruit or nut-bearing trees and vines. Also watch related party purchases. Bonus generally requires the right kind of acquisition, and related party rules can kill it. Timing and percentages matter too. Under TCJA, bonus started phasing down, like 60% in 2024. Then ABA permanently restored 100% bonus for qualified property acquired and placed in service after January 19, 2025. For exam purposes, focus on the concept. Bonus is a percentage of basis applied in the placed in service year, and it changes by law and year. They'll test whether you know it's not a fixed 100% forever. Electing out is where people get burned. If you want out of bonus, you must elect out on a timely filed return, including extensions. Miss that deadline and you don't get to opt out later. Even worse, depreciation must be computed as if bonus was claimed, even if you forgot to take it. On the EA exam, that's the trap. No election means bonus is baked into the depreciation schedule. The election out is made by class, not by individual asset. So you elect out for, say, 5-year property. And that applies to all qualified 5-year property placed in service that year. You can still take bonus on a different class, like 7-year, if you didn't elect out there. And if you filed timely, you can revoke a prior opt-out by amending. But you can't fix a missed election on a late original return. Harborview Realty Services made a $200,000 down payment on a commercial building and assumed the seller's mortgage of $120,000. They also paid $4,000 in attorney's fees for perfecting title and $20,000 for permanent improvements before placing it into service. The property tax bill values the land at $70,000. What is Harborview's basis for depreciation? Options include $274,000, $250,000, $324,000, and $320,000. Think about it. The answer is $274,000. Start with total cost basis, the down payment plus assumed mortgage, plus title attorney fees, plus the improvements. That's $200,000 plus $120,000 plus $4,000 plus $20,000, or $344,000. Then subtract the land value, because land is not depreciable. $344,000 minus $70,000 equals $274,000. A tempting wrong answer is $344,000, because people forget to carve out land. Which farm structure would be eligible for accelerated depreciation methods, such as Section 179? The choices are a residential rental property on the farm rented to sharecroppers, a single-purpose greenhouse, none because land and structures attached to land don't qualify, or a parcel of farmland. Think about what counts as qualifying Section 179 property. The correct answer is a single-purpose greenhouse. A single-purpose agricultural or horticultural structure can qualify for accelerated methods, including Section 179 if the other requirements are met. The tempting wrong choice is none, because people overgeneralize that buildings never qualify. Farmland itself isn't depreciable, and residential rental property is generally real property with different rules.